statistics would seem to indicate that the recent strength in gold, and by recent I mean the last 2 years, has been more a function of central bank buying than retail buying, even in China. The Chinese market, and to a lesser extent the Indian market, has seen more retail buying than the US market, which has in fact seen retail selling. But the statistics would suggest that the buyers of gold in real size have been foreign central banks, reacting, I suspect, by the US government's attempt to weaponize the US dollar, whether it is seizing $300 billion worth of Russian holdings of U.S. Treasury securities, which should make any country that holds its wealth in U.S. Treasuries concerned, or the weaponization of the SWIFT banking system by the U.S. to reinforce sanctions. Whether or not, as an American, you agree with those policies or not, they're disquieting to foreign central banks who have suddenly come to understand that denominating all of their foreign currency transactions and their national savings in U.S. dollars and U.S. Treasury securities is not a good thing. With regards to the difference between Chinese buying, that is Chinese retail buying, and U.S. retail buying, the Chinese government has an official policy of encouraging their savers to save, among other things, in gold, which is to say that they have facilitated gold transactions and encouraged it after, a policy many years ago of making it illegal. So there's probably an awful lot of pent-up demand in China, which is also facilitated by the Chinese government. And as you say, the weakness in the renminbi has meant that while gold has done well in US dollars, it's done very, very, very well in renminbi. Gold has traditionally been both a store of value and a medium of exchange. That's important to understand. While it doesn't provide a yield like U.S. Treasuries in terms of being a savings instrument for the Chinese central bank, it provides them more security of principle than other currencies of trading partners that they may have, the Russians as an example, or the Chinese. So gold is, I think, for the Chinese central banks and for many other central banks, fulfilling its traditional role, both as a medium of exchange and as a store of value. Imagine if you were the Chinese and you ended up with several trillion rubles and you didn't have the ability to spend it on anything from Russia. When it was efficacious for them to denominate their trade in US dollars, they did it, and they did it comfortably for years, and they were for years the largest holders of US treasuries. The relationship between the US government and the Chinese government now probably leaves the Chinese no choice but to reduce their holdings of US treasuries and substitute gold for that asset class. I'm not a foreign policy analyst, and I'm not a military analyst. I am pretty good at looking at statistics around gold and the response by central banks around the world when they feel that their own self-interest is threatened by the U.S. government are responding by buying gold. It will be interesting, I think, if retail buying in Western Europe and North America begins to follow through on top of central bank buying. All of us around the gold community looked at who the former buyer of gold was when gold was strong, which is to say individual savers. This is really a new phenomenon for us, to have the market being led by institutions. We all thought that gold was the anti-institution instrument, but it's strange to see the strength in gold led by institution with thus far very little retail follow-through. If you layer retail follow-through on top of this institutional strength, because both constituencies have an interest in gold, I think you could see a very, very interesting move. When people say that gold is broken up to new all-time highs, they're talking about nominal highs, not inflation-adjusted highs. Work that I have seen by the World Gold Council suggests that in constant dollars, that gold would have to break out above 2,700 to get to new real highs. It's interesting that when people talk about money, they don't talk about money in terms of the constant. When you talk about gold, you are talking about the constant. So my suggestion would be for gold to take out the old highs, which I think it will do, it would have to go through 2,700. For me, gold isn't a trading vehicle. For me, gold is a store of wealth, a medium of exchange, liquidity, and insurance. And I own gold because I'm afraid of our incomprehensible debt level. I own gold because the interest expense of the U.S. government is, I think, and I say the U.S. government, but I could just as well say the EU or Canada, is going to overwhelm our ability to sustain it. I'm old enough that I remember the decade of the 70s. We dealt with it by inflating away the purchasing power of the instrument that the debt was denominated in. Over the course of the decade of the 1980s, the constant purchasing power of the US dollar declined by 80%. I think that sort of thing is precisely what's on offer now. If that's right, and I believe it's right, if that's right, you could be talking about a gold price that was $7,000 or $8,000 or $9,000 or $10,000. Am I saying gold is going to go to $10,000? No, but I'm saying that there is a strong enough possibility of it, and the consequences of that for you maintaining your lifestyle with a US dollar denominated balance sheet would be very unpleasant. So I think that people who are concerned about those things need to own gold. And I think that message circulates well. And I think for better or worse, the gold price goes higher and perhaps much higher. What I told people about silver was that traditionally silver followed gold, that gold needed to move. The narrative needed to be established by gold, and then silver would follow through. There was so much hate around the silver stocks, probably as a consequence of their fail during the 2020 and 2021 silver squeeze. I like to say there's no hate more sincere than the hate of a jilted lover. And silver and the silver stocks certainly built up a lot of jilted lovers, young jilted lovers, particularly passionate ones in 2020 and 2021. The consequence of that is that the silver stocks got way oversold. In my career, that's happened 3 times before, and I'd adore to see it happen again. I own gold, or physical bullion, I guess is insurance. I own the silver stocks as a speculator, and describing them as coiled springs, I think is really accurate. There is not enough market cap in the legitimate silver stock space to handle the capital that will come into the space if the generalist investor buys into that narrative. I've seen that happen before. I remember the early part of the decade of the 90s, that move in silver, when things like Pan American silver went from 50 cents to $45, Silver Standard from 72 cents to $45. I'm not saying it's going to happen again, but I'd sure like to be part of it if it does. I think sadly neither party cares much about the economy. I haven't seen any evidence going all the way back to the so-called Reagan Revolution that the Republicans are much better stewards of the nation's balance sheet than the Democrats. I think we're in the throes of culture wars. I think you, on one side, have a progressive, others would say woke ideology, and on the other side, you have a reactionary ideology. I'm not particularly drawn to either of them, frankly. I'm much more concerned about the value proposition that if you leave me alone, I'll leave you alone. But that doesn't seem to be on offer. Trump, as an example, is on record saying that, as an example, Social Security payments are too low. Social Security is unsustainable. Medicare and Medicaid are unsustainable. Those are bad words, but they have a certain meaning in English around arithmetic, and they're true. I don't see the Democrats having any interest in reducing current spending, and I don't see the Republicans having any interest in reducing current spending. The Republicans might be in favor of a tax cut, but a tax cut without a spending cut is only a tax deferral. You have to borrow it or you have to print. I think it's absolutely inescapable that to the extent that we build up more US dollar obligations, the only way we finance our way out of it is to devalue the US dollar. We're not devaluing the US dollar against other currencies because they're doing the same thing. I don't know the quantum, but I do remember in the decade of the 70s, that if you go from 1970 to 1980, the constant purchasing power of the US dollar declined by 80%. And I suspect that that's what's going to happen to the holders of US dollar denominated savings products in the next 10 or 15 years.